Hey financial warriors, welcome to the show. And US inflation is currently running at 7.5% according to the latest data and may still go higher. And I know that a lot of people are worrying about how to protect their money from inflation, and perhaps your side hustle of selling your used underwear on eBay isn't going too well. So let's look at some ways to protect your cash from inflation eating away its value. But first of all, if you don't know the exact definition of inflation, what exactly is it? It is the decline of purchasing power of a given currency over time. So if US inflation is running at 7.5% and you have, say, $100 and you wait until next year, well, next year that $100 would only be able to buy you the same amount of stuff as $92.50 would have done this year. So with bank interest rates currently at pitiful levels, how are you going to protect your money from inflation? Well, in this video, we are going to look at 5 ways to protect your money from inflation. Some are better than others. Let's go. Number 1. Series I savings bonds. These are bonds from the US Treasury that are directly linked to the rate of inflation, and they earn interest in 2 ways: a fixed rate that stays for the lifetime of the bond and an inflation rate that is adjusted twice a year. Now currently the bond yield is 7.12%, which according to the latest month's figures is slightly below the inflation rate. However, if you go by the previous month's data, it would be slightly above, okay? And the bonds will be adjusted in April, and generally they do sit at or slightly above the inflation rate. Now you may just think, why not just put all my money into I bonds? Well, you're only allowed to buy $10,000 worth of them per year through the government's Treasury Direct website. However, the bonds will continue to earn interest for 30 years, and you can build up a big stash of them by buying $10,000 worth of them per year. You can cash them out after 1 year, but if you cash them out before 5 years, you lose the previous 3 months interest. I bonds are subject to federal income tax on the earnings. However, if you use the proceeds to pay for education, you may be able to avoid federal taxes. Number 2, earning interest on stablecoins. Now this one involves converting your US dollars to cryptocurrency and then staking those coins for an interest yield, just like earning interest in a bank account, if bank accounts actually paid any interest. Hello, darkness, my old friend. But wait a minute, aren't cryptocurrencies highly volatile? What if they lose value? Well, in this example, we're going to mostly be looking at stablecoins that are pegged 1-to-1 with the US dollar. For example, you can earn interest on USDT or Tether, which is one of the most common stablecoins, using the new lending network on ApeSwap. This was just launched. You can earn over 12% annual return on Tether in the form of banana tokens, their native token. You can then cash out the banana tokens immediately, or you can hold them and see if they increase in value. If you want a higher interest rate, you can look into Binance Coin or BNB Coin, which does fluctuate in value, but it is the number 4 cryptocurrency by market cap, right behind Bitcoin, Ethereum, and Tether. So it's not some dog meme coin that's going to crash to zero, and you can earn a whopping 18% interest on that, beating inflation by 2.5 times, and the coin may rise in value in addition to that. Now, ApeSwap did actually sponsor this video, and if you're interested in their service, do click the link below to check it out. You can find their lending platform here. They use MetaMask wallet on the Binance Smart Chain, so if you've bought NFTs on OpenSea, you will have used MetaMask on the Ethereum mainnet. You need to add Binance Smart Chain to your wallet. You can then buy BUSD or BNB on Binance or whatever exchange you find sells them, and you want to then send them to MetaMask where they can be used through ApeSwap. I'm going to do a little demo for you now, and personally I like the sound of 18% interest, and BNB coin isn't exactly at all-time highs anyway, so it should be a reasonably safe buy. It'll probably go up rather than down over the next few months, depending on market conditions, of course, not financial advice. So here we go. I'm going to hit the max, and I got a bit over $100 worth of BNB coin. I'm going to decrease the amount ever so slightly to account for gas fees, which are very low compared to Ethereum. And boom, there we go, $99 worth of BNB coin earning interest at 18%. Anyway, if you want to check out ApeSwap, do click the link below. Otherwise, let's move on to the next inflation-beating investment. Number 3, dividend stocks. Inflation hurts high growth and tech stocks like the FANGs and Tesla. The Nasdaq was at a 6-month low at the end of January and is still flirting with those levels now. So why does inflation hurt high growth stocks? Well, as the cost of just general items rises, the company's expenses will rise. Then the Fed raises rates to fight inflation, and that causes the cost of borrowing money to become more expensive, which further hurts the company's profits. And then as rates rise, bonds and other savings accounts and things just start to become a little bit more enticing to investors, and some investors go and invest there instead of in these high growth stocks, and that can slump the stock price even more. But dividend stocks have been somewhat of a safe haven in times of market downturns and high inflation. Dividends have actually accounted for 40% of the market returns since 1930, and in times of high inflation, such as in the 1970s, dividends actually accounted for 71% of the market return during that period. Now, what is more, analysts predict that many companies that cut their dividends in the year 2020 in reaction to the pandemic will reinstate them this year. Now, in normal times, I would recommend looking at the dividend aristocrats. These are companies in the S&P 500 that have paid and increased their dividends every year for the past 25 years. But since inflation is so high right now, many of them do not have dividends at a level where they could beat inflation, so you may want to look outside of the aristocrats. However, it does come with a little more risk. Let's take a look. You've got companies like AGNC Investment Corp, which is a real estate investment trust, and it's currently paying a 10% dividend. Antero Midstream, an oil company, paying a 9.5% dividend. And Rio Tinto Mining Corporation, which has been a company I've invested in a lot over the years, is currently paying 8.89%. Basically, it's a great time to invest into dividend-paying stocks of companies that are related to things that would hurt if you drop them on your foot, like rocks, a barrel of oil, building materials, etc. The great thing about dividends too is that if you buy now, as the price of the stock and the dividend rises in the future, the percentage yield that you are getting is always measured in relation to the price that you paid in the first place, okay? So 9% now could equal 15% a few years down the line. Just a word of warning though, high dividends can be a signal that a company is in financial trouble. It may have experienced a sudden stock price drop and it's gonna cut its dividend in the future. So if you see dividends in the sort of 15% range, that's normally too good to be true territory. Even 10%, you do want to do your own research. I think sort of the high single digits is really going to be as high as you want to go, perhaps around 10% for certain companies. All right, let's move on to the next one. Number 4, gold and precious metals. Now, traditionally, gold and other precious metals are seen as a hedge against inflation. However, this idea has been challenged in recent decades, and actually gold hasn't produced a positive return during periods of prolonged inflation since the 1970s. Actually, in the past year, as inflation has risen, gold has ever so slightly decreased in price. In the last couple of decades, Bitcoin, which is often referred to as digital gold, has taken a lot of that inflation hedging business away from gold, and you've got real estate investment trusts too. But I would still say holding a little bit of gold in your portfolio, even if it is through exposure to gold miners, like through an ETF such as GDXJ, is a good idea. You can also buy small amounts of physical gold and silver, etc., but you'll need somewhere to store them. For me, gold is not so much a hedge against inflation, but a hedge against a sort of Mad Max type situation. I guess water and bullets would be a good hedge against that too. And thus, it only occupies a small portion of my portfolio. Right, let's now move on to our last inflation-beating investment. Number 5. Long-term debt. Now, inflation actually benefits holders of long-term debt, like people with mortgages, since over time, their mortgage payment will stay exactly the same as long as they've got a fixed rate, and most people these days have, whilst their income, at least in theory, should rise with inflation. To give an example, let's say a person's mortgage payment is $1,500 a month and he earns $5,000 a month. That's 30% of his salary. But if, because of inflation over the course of a couple of years, his pay rises to $5,500 a month, well, his mortgage payment won't change as long as he has a fixed rate. So his mortgage payment has now decreased to only 27% of his monthly income, whilst the guy renting next door has had his rent raised by the landlord. Perhaps in 10 years' time, our guy is now earning $7,000 a month because of inflation and wages rising, etc., but his mortgage payment is still just $1,500. It's now only 21% of his income. So arguably right now, it's an excellent time to buy a house from this point of view, because interest rates are still low and inflation is high. But that's only part of the picture, since huge demand in some markets and a shortage of materials has driven prices up. But often getting a lower interest rate is still a better deal, even if you pay a bit more for the property. For example, if you increase your rate from 3.5% to 4.5% on a $350,000 house, you'll pay over $60,000 more in interest over 30 years. So you definitely need to do your own research on this, and it'll be heavily influenced by what housing market you're buying in, etc. But at least in principle, inflation does benefit holders of long-term debt. All right, guys, that is the video for today. Thank you so much for watching, and thank you to ApeSwap for sponsoring. You can check out their service in the links below and start earning some amazing interest rates on your stablecoins and other cryptos. Please subscribe to our channel if you're new, and we'll see you next time. Bye-bye.